Leggett Platt stock, ticker symbol LEG. This stock is down 20% year to date, which is of course quite a lot, but the S&P 500 is down 23%, so that's almost the same. LEG stock is loved among the investors because of the dividends, of course. They pay out a 5.5% dividend yield, which is of course pretty attractive. But how about the fundamentals of the stock, and what about the price target? In this video I'm going to show you real quickly what Leggett Platt does, the historical returns, the fundamental analysis, dividends, and in the last part I'm giving you my price target to see if they are a buy or not. And I think you definitely want to see that part, so make sure to watch until the end. And I'm also very excited to see what you guys think about this stock, so please let me know your thoughts in the comments. My name is Thomas and this is Thomas Invest. I'm an investor looking for great stocks at great prices. So, what does Leggett Platt do? Leggett Platt designs and produces engineered components and products found in most homes and automobiles. It operates its business through three segments, namely bedding products, specialized products, and furniture, flooring, and textile products. When we dive in the most recent earnings report, we see that Q2 were a quarterly record 1.33 billion, which is a 5% growth year over year. Volume was down 6% and raw material related price increases added 13% to sales. Currency impact decreased sales by 2%. EBIT margin was 10.7%, down 60 bps year over year, when margin was at 11.3%. EPS was up 4 cents year over year. They also lowered the 2022 guidance. Sales is expected to be in a range of 5.2 to 5.4 billion. Versus the prior range of 5.3 to 5.6 billion, up 2 to 6% year over year. Volume expected to be down low to mid single digit versus roughly flat. Inflationary impact expected primarily from raw material related price increases, including those implemented in 2021. Currency expected to negatively impact sales. In the most recent quarter, it had an impact of 2%. EPS is lowered to a range of 2.65 to 2.80 versus prior range of 2.70 to $3, which is a big difference, mostly because of lower volume and margin expansion. In this sheet we see the segment summary. Bedding products has a flat organic growth and margin is down 60 bps. Specialized products has an 8% organic sales growth, but margins are down 310 bps, which is a big difference. Furniture, flooring and textile products had a 10% organic sales growth and margins are up 40 bps. If we zoom in on the bedding products, we see that volume has decreased 50%, while raw material related selling prices added 16%. Specialized products organic sales were up 8%, with an 11% increase in volume, driven by automotive, aerospace and hydraulic cylinders. And raw material related selling price increases added 3%. Currency impact decreased sales by 6%. Furniture, flooring, textile organic sales were up 10%, while volume was down 2%. Raw material related selling price increases added 13%. So overall, I think these earnings were very interesting and we see a few interesting things happening with the volume but also the currency impact. Margins are down, which is something that I don't like to see. And now that we know more about Leggett Platt, it's time to check the historical returns to see what happened there. I decided to include the S&P 500 as a benchmark, since this is one of the easiest ways to invest. Just buy an S&P 500 ETF and wait. Next to that, I decided to include KBO, HGV and LNW. On the 5-year chart we see that the S&P 500 did beat all stocks in this list and Leggett Platt has a negative return of 19%, which isn't very good of course, since this is including dividends. On the 1-year chart we see that again the S&P 500 did way better than all the other stocks in this list. On the 6-month chart we see a minus 8% return for LEG stock, which is way better than all the others in this list, so that's very interesting. On the 1-month chart, only LNW had a better return than the S&P 500, so it seems that almost in every scenario the S&P 500 was the best investment here, which is quite interesting. All stocks, including LEG stock, had a really low return. So does this mean that LEG stock could be a buy? Let's check the fundamentals of this stock. But first, if you made it this far into the video, I want to thank you a lot for watching this video. Make sure to subscribe and in return you'll receive similar analysis to this one every week. Let's continue by diving into the fundamentals. Leggett Platt is a 4.46 billion market cap company with a PE ratio of only 11, which could indicate that they are undervalued. Later in this video I will show you my 3 price targets, so make sure to watch until the end. Trading 12-month revenue is at 5.3 billion, which is higher than the actual market cap, so that's very interesting to see. In this graph we see that revenue went up in the long run, which is a good thing, but to be honest it's not always that consistent. Net income is at 388 million, which gives us a profit margin of 7.3%, which is higher than the 5-year average of 6.9%. But keep in mind that margins are expected to decrease in the coming periods, as we saw earlier in the earnings report. In this graph we see the earnings per share. You want a steady and consistent pattern here, as it has gone up and down quite a lot. So to be honest, I don't like this that much. Next up are the analysis estimates. If we take a look at the upcoming 5 years, we see that analysis expect a single-digit growth in EPS and even a low single-digit revenue growth. So that's indicating that the company will growing very slowly, and by buying back shares, they will create some value to the investors, alongside the dividends of course. In this graph we see the price to free cash flow over the past couple of years. We want this number to be at least below 20, but it also depends on the industry and type of company of course. Right now it's at 16, which is fine by me, but keep in mind that we expect a slow growing company in the coming years, which could mean that you don't want to overpay for this company. The current price to book ratio is at 2.6. Traditionally, any value under 1 is considered a good price to book ratio. Value investors indicating a potential undervalued stock. However, value investors may often consider stocks with a price to book ratio value under 3 as their benchmark. To me, 2.6 isn't that good of a number for this type of company. Price to sales is at 0.8, which is pretty decent for this type of company. While the ideal ratio depends on the company and industry of course, the price to sales ratio is typically good when the value falls between 1 and 2. A price to sales ratio with a value less than 1 could be better. Leggett Platt stock has a lot of that compared to the current cash position. And of course this is something that I don't like that much. I prefer companies who can pay down at least 33% of the total debt. Right now total cash is at 269 million, while debt is at 2.29 billion. So this is something to keep your eye on. Next to that, it's of course very important that free cash flow is growing, since this is used to pay down debt of course, but also to buy back shares, pay dividends, do acquisitions and a lot of things. Free cash flow has gone up and down quite a lot, which is something that I don't like that much to be honest. Especially in 2022, free cash flow seemed to be a bit low, which concerns me a bit, so keep an eye on that number. Another thing to keep your eye on are the shares outstanding. They used to buy back shares back in the days, but ever since 2018 they didn't bought back any shares, which is something that I don't like of course. They even issued new shares. By buying back shares you increase the EPS and ownership for the investor. Next to that it will be easier to maintain and increase the dividends of course, so definitely keep an eye on this number, since they are diluting you right now. But since we're talking about dividends anyway, the dividend scorecard is where all the value seems to be. Dividend yield is at 5.5%, which is of course pretty high. Annual payout is at $1.76 and they have a 60% payout ratio, meaning they have 40% left in cash to pay down debt, buy back shares, do acquisitions and a lot of things. I prefer a payout ratio of 50% or lower, so definitely keep an eye on this number. The 5-year growth rate is at 4.2%, which isn't the highest of course, but with the dividend yield sitting above 5%, I don't mind that much. They grew the dividends for 28 years in a row, which is pretty impressive. Overall, a great dividend stock in my opinion, and the only downside is the payout ratio, and with the free cash flow being down year over year, this is something to keep your eye on, but to be honest, it doesn't worry me that much. But does this mean that LEG stock is a buy? Well, let's check the 3 price targets that I created using the Everything Money software, which is one of the best tools out there. I'm using a low, mid and high assumption to get the 3 price targets, starting off with revenue growth. I expect things to slow down a little bit. Volume is down right now and analysis expecting also that there will be a low single digit growth company in the coming years. So I'm filling in 1, 2.5 and 4% here. Profit margin is kinda consistent based on the average, so I fill in 6, 6.5 and 7%. Free cash flow margin I'm filling in 5, 6 and 7%. And since this is a slow growing company, I want to pay a low multiple of earnings and free cash flow. So that's why I'm going for 10, 11 and 12. My desired annual return is 12.5%, since I can get an easy 10% average annual return with owning an ETF. Right now, current stock price is at $32.5. I hit analyze and we see a lot of red numbers. We have low price targets of $17 to $21, which is roughly a 40% drop. We have a mid-price target of $24 to $26, which is also a big drop. And we have a high price target of $32.97, which is slightly above the current stock price, so that's not a lot of potential there. In my opinion, the mid-price target is the most justified here, so that will mean a 20 to 30% drop in stock price to be fairly valued. My final conclusion on the stock is that from a value point of investing, there's not a lot of potential right now. It's a boring, slow-growing company, but that could be very interesting for the dividend investors, of course. Dividend yield is very high and they seem to love to increase the dividends, which is a good thing for the dividend investor. For now, I'm skipping this stock because I think there are better deals out there and they are overvalued by roughly 20 to 40%. But remember to always do your own research and never fully trust on what I or other YouTubers say about the stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insights of the company to you. I'd really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.